Hey everyone, today we're going under the hood to look at the invisible architecture that secretly shapes every financial market out there. We're talking about support and resistance.
But before we get into the nitty-gritty, I want you to just take a look at this number, $1.9 trillion. That's the estimated amount retail traders lost in 2023 alone. And believe it or not, a huge slice of that comes from a simple misunderstanding of the very thing we're going to talk about today. So, what is going on here?
And that really brings us to the big question, doesn't it? Why is it that the most basic, most widely taught concept in all of technical analysis is also one of the things people get wrong the most? Well, the answer is way more fascinating than you'd think, and I'll give you a hint. It has almost nothing to do with just drawing lines on a chart.
This is what I call the trillion-dollar paradox. See, the problem isn't that support and resistance are super complicated. It's the exact opposite. They've been made dangerously simple. We're taught to see them one way, but the market sees them in a completely different light.
Okay, so this slide right here gets to the absolute heart of the problem. The myth, what we're all taught, is that these are just static floors and ceilings. But the reality? Oh, it's so much deeper. They're actually dynamic, living zones created by the collective psychology of millions of people. It's not a battle of price points, it's a battle of minds.
And that is the absolute key you have to understand. These levels aren't just some technical blips on a screen. Nope. They are the direct, predictable result of human behavior. So if you really want to understand them, you have to stop trading patterns and start trading people.
And the main psychological force at work here is something called anchoring bias. Think about it. When a stock rockets up to, say, $100 and then reverses hard, that $100 price gets seared into the market's collective memory. It becomes an anchor, a reference point that powerfully influences every future decision around that price.
And this is just a brilliant illustration of how that anchor works in practice. Right at that one spot, that $100 level, you get this incredible convergence of totally different motives. You've got buyers who bought before wanting to add more. You've got short sellers looking to take their profits. You've got new buyers who've been waiting for a dip. And you've even got sellers who are trapped, just praying to get out at break even. It's a perfect storm.
Now look, this isn't just some fluffy theory. A huge study back in 2018 in the Journal of Financial Economics actually put a number on it. They found that a price has a 23% higher probability of reversing near a major previous high or low compared to just some random price. That's a real, quantifiable statistical edge, and it's all rooted in psychology.
So we've got the psychology down. That's the why. But what about the how? How does this actually work on a mechanical level? For that, we've got to look beyond what we can see on the chart and peer into the invisible mechanics of the market itself.
You know, when a price starts falling towards a big support level, it sets off this incredible chain reaction. First, you have a literal wall of pre-placed buy orders waiting there. Then, as price gets close, short sellers are forced to buy to close out their positions. At the exact same time, mean reversion algorithms fire off automated buy signals. It's this cascade, this waterfall of buying pressure all at once.
And speaking of algorithms, you just cannot ignore the elephant in the room, or maybe the 800-pound gorilla. As you can see here, up to 75% of all trading volume today is automated. These algos are literally programmed to buy and sell at these exact psychological levels, creating this massive, powerful, self-fulfilling prophecy that just makes them even stronger.
Okay, so if we know all this, how do we get better than just eyeballing a chart and hoping for the best? Well, the modern approach is all about transforming this from a subjective art into an objective science. It's about actually quantifying that invisible market structure.
For decades, this was how it was done, right? A trader pulls up a chart, squints a little, and draws a line where they think a level should be. It's a process that's just loaded with personal biases. It's messy, it's subjective, and frankly, we can do a lot better. And one of the most powerful tools for doing that is what's called the point of control, or POC. Now, instead of just looking at where the price turned around, the POC shows you where the most business was actually done. It's the point of maximum agreement, and it acts like a center of gravity for price. It's the true fair value.
We can even take it a step further and create an objective scoring system, something like this. What we're doing here is taking all those key factors, like how many times the level was tested, its historical success rate, the volume traded there, and we're giving each a weighted score. This spits out a final number that tells us objectively how strong a level is, so we can focus only on the absolute A+ setups.
All right,
We've covered a lot. We've got the psychology, the mechanics, the data analysis. So now for the most important part. How do we put all this together into a real, actionable strategy? Let's build a framework.
So here it is, a powerful 5-step framework that the pros use. Step 1, start on the bigger picture, the higher time frames. Step 2, score the strength of the levels you find. Don't just guess. 3, wait for confluence, where multiple reasons to take a trade all line up. 4, and this one is so crucial, require confirmation. Don't just buy because price is there. And finally, number 5, the most important rule of all. Always, always know where you're wrong and define your risk before you ever click the button.
And I want to leave you with this idea, because it really gets to the heart of trading these levels. It's a mental game. The biggest, most powerful bounces from support, they often happen right after a moment of maximum fear, when everyone else has been flushed out. Which means the best opportunities are often the ones that feel the most uncomfortable to take.
So I guess the final question you have to ask yourself is this. Are you just trading lines on a chart, just reacting to simple patterns? Or are you trading the collective hopes, the fears, and the motivations of all the other people on the other side of your screen? Because honestly, the answer to that one question, it can make all the difference in the world.